Today we're diving into a critical economic phenomena, recession. What exactly are they? How do they impact our lives and the global economy? In this video, we'll unpack key insights to help you understand recession, from their causes to their far-reaching consequences. Let's get started. A recession is typically defined as 2 consecutive quarters of declining GDP, signaling a widespread economic slowdown. However, the National Bureau of Economic Research (NBER) uses a broader definition, including income, employment, and consumer spending. Recessions are marked by rising unemployment, falling retail sales, and reduced industrial production. For instance, during the 2008 crisis, US unemployment spiked to 10%, while GDP contracted by 4.3%. These indicators collectively paint a picture of economic distress, affecting households and businesses alike. Recessions disrupt livelihoods, shrink investments, and strain public resources. Understanding their mechanics empowers individuals and policymakers to respond effectively. Recessions can stem from economic shocks like the 2020 COVID-19 pandemic or financial crisis such as the 2008 housing bubble burst. Other triggers include high inflation, excessive debt, and geopolitical conflicts. Recessions also vary in shape. V-shaped, sharp decline followed by rapid recovery. Example, 2020. Second one is U-shaped, prolonged slump before recovery. Example, 1970s oil crisis. And L-shaped, long-term stagnation. Example, Japan's 1990s lost decade. Each type demands tailored policy responses, from stimulus packages to structural reforms. History offers stark lessons. The Great Depression, 1929 to 1939, saw GDP drop by 30% with unemployment hitting 25%. Franklin D. Roosevelt's New Deal programs revitalized infrastructure and created jobs. In 2008, central banks slashed interest rates and launched quantitative easing to stabilize markets. The US Congress passed the $700 billion TARP program to bail out banks. These interventions underscore the critical role of monetary and fiscal policy in crisis management. Recessions ripple across borders. The 2008 crisis reduced global trade by 12%, hitting export-driven economies like Germany and China. Protectionist policies often rise, as seen with the US-China trade war. Sociopolitically, recessions fuel unrest. The Arab Spring 2011 was partly driven by soaring food prices and youth unemployment. Governments face pressure to balance austerity with social spending. Central banks are frontline defenders during recessions. Their primary tool, monetary policy. By adjusting interest rates and injecting liquidity, they aim to stimulate borrowing and spending. For example, During the 2008 crisis, the US Federal Reserve slashed rates to near zero and launched quantitative easing, buying trillions in bonds to stabilize markets. However, prolonged low rates can create risks such as asset bubbles or reduced savings incentives. The European Central Bank's negative interest rate policy post 2012 sparked debates about long-term consequences. Central banks walk a tightrope between short-term relief and sustainable growth. Consumer spending drives 70% of GDP in economies like the US during recessions. Fear of job loss and income reduction lead to declines in consumer confidence. For instance, the 2020 pandemic saw US consumer sentiment plummet to decade lows, worsening the downturn. Paradoxically, panic-driven hoarding, example, toilet paper shortages in 2020 can distort markets. Governments often use messaging campaigns to restore confidence, like the 2009 Cash for Clunkers program to boost auto sales. Understanding this psychology helps policymakers design targeted interventions. Well viewers, if you didn't subscribe to our channel yet, please subscribe now. Unemployment is a recession's most visible scar. In 2020, global unemployment rose by 33 million with youth and low-wage workers hit hardest. Long-term joblessness can lead to skill erosion and permanent income loss, as seen in the hysteresis effect of Europe's 1980s recessions. Automation accelerates during downturns as companies cut costs. The 2008 crisis fast-tracked AI adoption in manufacturing, displacing workers. Retraining programs like Germany's Kurzarbeit, short-time work schemes, are critical to preserving human capital. Real estate often fuels and suffers from recessions. The 2008 subprime mortgage crisis erased $16 trillion in global household wealth. Falling home prices trapped homeowners in negative equity, reducing spending and deepening the slump. Recessions also widen wealth gaps. The top 1% often recover faster, while stock market rebounds, while middle class wealth tied to housing stagnates. Post-2008, US racial wealth disparities grew, with black families losing 40% of their net worth. Globalization amplifies recessions. A factory shutdown in China can disrupt auto production in Germany, as seen during COVID-19. However, interconnectedness also aids recovery. Post-2008 emerging markets like India and Brazil helped rebalance global demand. Yet, reliance on foreign debt can backfire. Developing nations like Argentina and Turkey faced currency crisis during the 2018 to 2020 global slowdown. Recessions force a rethink of supply chain resilience and trade dependencies. Recessions paradoxically spur innovation. Startups like Uber and Airbnb emerged from the 2008 crisis, leveraging cheap talent and shifting consumer habits. Governments also invest in R&D to ignite growth. The US Inflation Reduction Act 2022 allocated $370 billion to clean energy. However, creative destruction leaves losers too. Traditional retailers like Blockbuster collapsed, while Amazon thrived. Adaptability is key for survival in turbulent times. High debt levels magnified recessions. Post 2008, Greece debt to GDP ratio hit 180%, triggering austerity riots and a 25% GDP contraction. Countries like Sri Lanka defaulted in 2022 amid food and fuel shortages. Even wealthy nations face strain. Japan's debt exceeds 260% of GDP, limiting stimulus options. Managing debt requires balancing austerity with growth, a lesson from the Eurozone crisis. So viewers, we explored critical facets of recessions, from central banks to debt crisis. Don't forget to like, subscribe, comment, and share our videos with your friends and family members. Take care and see you next time.